Technical analysis is a powerful tool for understanding price movements and market behavior. However, traders often fall into common traps that can weaken their analysis and lead to poor decision-making. In this lecture, we'll uncover these pitfalls and explore strategies to avoid them. By recognizing and addressing these mistakes, you can enhance your technical analysis skills and make more informed trading decisions. Let's dive in and maximize the benefits of technical analysis. One of the biggest mistakes traders make is relying solely on technical indicators without considering the broader market context. Economic events, geopolitical news, and overall market sentiment can significantly impact price movements, making technical signals less reliable in isolation. For example, an overbought RSI in a strong bullish economy may not lead to an immediate correction as expected. To improve accuracy, traders should combine technical analysis with fundamental data to gain a more comprehensive understanding of market conditions. This slide highlights how market context impacts technical indicators like the RSI. On the left, we see an overbought RSI during a strong bull market, yet the price continues to rise, showing that momentum can override traditional signals. On the right, the same RSI overbought condition in a calm market leads to a price decline, aligning with standard expectations. This demonstrates why traders shouldn't blindly rely on indicators without considering the broader economic and market environment. Relying on a single indicator can be a major pitfall in technical analysis, as it may lead to misleading or false signals. For example, depending solely on moving averages might not capture sudden price reversals or sharp market moves. No single indicator provides a complete market picture, which is why traders should use a combination of tools for confirmation. By integrating indicators like MACD, RSI, and moving averages, traders can improve accuracy and reduce the risk of making poor decisions. A multi-indicator approach helps validate signals and enhances overall trading strategy. This slide highlights the importance of using multiple confirmations rather than relying on a single indicator. On the left, we see a false sell signal based solely on RSI, which can be misleading in a strong trend. On the right, we used multiple confirmations for a stronger entry signal: a resistance breakout, RSI trending upward, and MACD shifting from red to green with a bullish crossover. These combined signals provide a much higher probability of a successful trade. One common mistake traders make is not considering multiple time frames, which can lead to misinterpretations of market trends. A short-term uptrend on a 5-minute chart might seem like a great buying opportunity, but if the daily trend is bearish, that trade could go against you. Failing to align different time frames can result in poor decision-making and unnecessary losses. To avoid this, traders should analyze multiple time frames, such as checking the daily trend before entering a trade on the 5-minute or hourly chart, to ensure their trades align with the broader market direction. This approach provides a clearer perspective and improves trade accuracy. This slide illustrates the danger of not accounting for multiple time frames when making trading decisions. On the left, the 5-minute chart shows an oversold RSI, which might suggest a buying opportunity. However, on the right, the daily chart of the same stock shows that during the same period, RSI is actually overbought, indicating a potential reversal. This mismatch can lead traders to make poor decisions if they don't check higher time frames for confirmation. To avoid this mistake, always analyze multiple time frames to ensure short-term signals align with the broader trend before entering a trade. One common mistake traders make is forcing patterns to fit their expectations rather than objectively identifying them. This often leads to misinterpreting random price fluctuations as meaningful formations, such as seeing a head and shoulders or double top pattern where none actually exist. Relying on such false patterns can result in poor trading decisions and unnecessary losses. To avoid this, traders should use clear, objective criteria for pattern recognition rather than letting bias influence their analysis. Staying disciplined and verifying patterns with additional indicators helps improve accuracy and decision-making. This slide illustrates the difference between misidentifying random price movements as patterns and correctly recognizing a valid formation. On the left, traders might mistakenly see a head and shoulders pattern in market noise, leading to premature trades. On the right, we have a well-formed head and shoulders pattern, which follows clear structural criteria and results in a strong price decline. The key takeaway is to avoid forcing patterns where they don't exist and instead apply objective confirmation rules. Proper pattern recognition helps traders make more reliable and confident decisions. Many traders focus only on price action while ignoring volume data, which can lead to misleading conclusions. A price breakout, for example, may look promising, but if it occurs on low volume, there's a higher risk that it's a false breakout and won't sustain. Volume serves as a confirmation tool, helping traders gauge the strength behind a price move. By analyzing volume trends, traders can differentiate between weak and strong moves, improving their trade decisions. Always consider volume alongside price action to validate breakouts and trend reversals effectively. This slide highlights the importance of volume in confirming price breakouts. On the left, we see a false breakout that occurs with low volume, which fails to sustain and results in a price pullback. On the right, a second breakout happens, but this time with significantly higher volume, leading to a strong upward move. This demonstrates why traders should always check volume before acting on a breakout signal. High volume confirms strong market participation, increasing the likelihood of a successful breakout, while low volume can indicate weakness and potential failure. Neglecting risk management is one of the most dangerous mistakes traders can make. Overconfidence in a technical setup can lead to excessive risk-taking, such as entering a large position based on a single bullish signal without a stop-loss. This approach can quickly result in significant losses if the trade goes against expectations. To protect capital, traders should always set predefined risk limits and use stop-loss orders to manage potential downside. A disciplined risk management strategy helps ensure long-term success in trading. This slide emphasizes the importance of risk management by identifying proper entry points and stop-loss placement. The chart shows potential entry points, but without a well-placed stop-loss, even a strong trend can turn into a losing trade. By setting a stop-loss below key support levels, traders limit their downside risk while maintaining a favorable risk-to-reward ratio. The suggested 1:3 profit-to-loss ratio ensures that even with a few losing trades, profitable ones can still outweigh the losses. Proper risk management is essential for long-term success and protecting trading capital. Consistency is key to success in trading, yet many traders make the mistake of frequently switching strategies without giving them enough time to prove effective. For example, jumping from scalping to swing trading without fully understanding each approach can lead to confusion and inconsistent results. Constantly changing methods prevents traders from learning, refining, and improving their strategy over time. To avoid this, it's essential to develop a solid trading plan and stick to it, making adjustments only after thorough evaluation. A disciplined and consistent approach leads to better long-term performance. Emotional trading is one of the biggest challenges traders face, as fear and greed often lead to impulsive decisions. For example, panic selling after a small price dip, despite strong technical support, can cause traders to exit positions too early. Similarly, greed can push traders to chase trades without proper analysis, leading to unnecessary risks. The key to overcoming emotional trading is to follow a well-defined trading plan and avoid reacting to short-term market noise. Discipline and patience are essential for making rational decisions and achieving long-term success in trading. Many traders misunderstand the difference between leading and lagging indicators, which can lead to poor trade timing. Lagging indicators, such as moving averages, confirm trends but don't predict future price movements, making them ineffective for early trade entries. On the other hand, Leading indicators like RSI or stochastic attempt to signal potential reversals before they happen. Relying solely on a lagging indicator for trade decisions can result in delayed entries and missed opportunities. The best approach is to combine both leading and lagging indicators appropriately to make well-informed trading decisions. Overtrading is a common mistake that can lead to unnecessary losses and emotional fatigue. Many traders overanalyze minor price fluctuations and take multiple trades based on small indicator movements, such as stochastic signals, without considering the bigger picture. This results in excessive trading fees, poor decision-making, and increased risk exposure. The key to avoiding overtrading is to focus on high-probability setups and only take trades that align with a well-defined strategy. By avoiding these common pitfalls, traders can significantly improve their technical analysis skills and achieve more consistent results. The key to success is maintaining discipline, using multiple indicators, and considering the broader market context to make informed trading decisions. However, it's important to remember that technical analysis is primarily a tool for identifying the best possible entry points. The foundation for selecting which stocks to trade comes from fundamental analysis, which we will explore in the next lectures. By combining both approaches, traders can develop a well-rounded strategy for long-term success.